Welcome to the Tree P&L Deep Dive. Before we start, a quick disclaimer. This analysis is for educational purposes only and does not constitute financial advice. Always do your own research. Now let's get into the numbers.
All right, today we are diving deep into Nation's Trust Bank, or NTB. We're looking at their 9-month results for 2025.
And we've got the full deck here, financial statements, the MD&A, some analyst notes.
Yep, the whole package. And our mission, as always, is to get past the spin. We want to find the true quality of these earnings.
To really find the engine driving this thing, not just admire the paint job.
Exactly.
And the paint job is definitely shiny. I mean, the headline numbers are grabbing everyone's attention.
Oh, absolutely. The documents are shouting about it. Net profit of LKR, $14.91 billion for the 9 months.
Which is, what, a 23% jump year over year? That's a huge number.
It is a very strong 23% compared to the LKR $12.17 billion they posted last year.
Yeah.
And a number like that, it gets the market's attention. It suggests some serious momentum.
But, and this is why we do this, as soon as you start sifting through the operational data, a huge contradiction just leached off the page.
It really does. It's a massive anomaly, and it's right at the heart of their whole growth story.
Which takes us right into our first section, the hook. The core contradiction.
That's it. We have this fantastic 23% profit growth, but when you look at what a bank actually does for a living lending, the numbers just don't add up.
They just don't align. It makes you question how solid that 23% really is.
So let's start with their strategy. The documents show NTB has been, astonishingly aggressive on the asset side.
Aggressive is an understatement. Their gross loan book surged by 45% year to date.
45%. In 9 months. That's not just growth. That's an all-out push for market share. It tells you management is deploying capital at a blistering pace.
Yeah, that's not incremental. That is explosive.
And you have to appreciate the scale of that. A 45% growth rate is extraordinary in banking. It means almost half of their entire loan portfolio was written in just the last 3 quarters.
Wow. If they kept that pace up, they'd double the size of the bank in, what, under 2 years?
Easily. So it's a massive, massive commitment to volume.
Okay, so with that kind of volume, basic banking logic would tell you that your core revenue, your net interest income, or NII, should be going through the roof as well.
It should be exploding right alongside it. NII is the bread and butter. It's what you earn on loans minus what you pay for deposits. It's the purest measure of a bank's core job.
And this is where the contradiction smacks you in the face.
This is it. Their net interest income grew by only 8% year over year. It hit LKR $28.82 billion.
So let's just pause on that. A 45% increase in your main activity.
A huge capital-intensive effort.
Results in a single-digit 8% increase in your core income.
It's like putting a supercharger on your car. You hear the engine roar, but your actual speed barely picks up.
So we have to ask, what is broken in the transmission? What is absorbing all the power from that 45% volume push?
The documents are pretty clear on this.
Right.
The mechanism is net interest margin compression, NIM for short.
And the squeeze looks pretty severe.
It is. The analysis shows NTB's NIM fell sharply. It's down to 6.15% from a much healthier 6.94% at the end of last year.
Okay, so nearly 80 basis points of compression in 9 months. That's a huge hit.
It's a direct consequence of the macro environment.
Right. Let's unpack that for a second, because NIM compression is so fundamental here. We know the central bank was cutting interest rates all through 2025 to stimulate the economy.
Exactly. And when rates fall, it hits a bank's income statement in 2 ways, and usually at 2 different speeds.
First, on the asset side, the money they're lending out, the yields on new loans drop almost immediately.
And NTB was pushing a ton of volume, that 45%, so they were writing all these new loans at these new lower rates.
But on the other side, the liabilities, the deposits they use to fund those loans, that cost is much stickier, isn't it?
Much stickier. A lot of those are fixed-term deposits that customers locked in back when rates were high. The bank is stuck paying those high rates until the term is up.
So your income from assets is repricing down really fast, but your cost of funds is repricing down really slowly.
And that's the squeeze. That's the NIM compression. It means for every 100 rupees they lend, they're just making less profit.
So the only way they could even get to an 8% NII growth was by just overwhelming the margin problem with pure raw volume.
That's exactly what they did. They ran faster just to stay in the same place profit-wise.
Which brings up a critical question for us as analysts. Management knew this was happening, so why? Why push for such insane loan growth in a shrinking margin environment?
It says a lot about their priorities. I don't think it was a mistake. I think it was a calculated risk.
You think they're prioritizing market share over short-term profitability?
It looks like it. They seem to be prioritizing long-term dominance. In a falling rate environment, that's often the best time to grab customers while your competitors might be pulling back, worried about the rate shock.
So they're willing to take a hit on the NAM now, down to 6.15%, if it means they can lock in a whole new generation of customers.
Especially in those high-fee businesses like trade finance, which we'll get to. These are sticky relationships that can generate fees for years and years.
That's the optimistic take.
The bearish take is that they're taking on a lot of duration risk holding. These long-term, low-yield assets funded by shorter-term liabilities. If rates suddenly reverse course next year, their funding costs could shoot up before their assets reprice.
So the key takeaway from this first section is pretty stark. That flashy 23% profit growth is definitely not coming from their core lending business being stronger. It's coming from volume just barely papering over some pretty serious margin pressure.
Precisely. Which leads us to the next logical question. If the core engine is sputtering along at 8%, where on earth did the rest of that 23% growth come from?
And that pivot takes us straight into section 2. A deep dive into their operational health to find the real drivers of this profit number.
Right. And this is where we need to separate the sustainable, repeatable earnings from, the one-off lucky breaks.
And the data here is just crystal clear. The bulk of that profit growth came from non-core income.
These were the heavy lifters that completely masked the softness in NII.
Let's start with the biggest one, the figure that just jumps out and makes you double-check the spreadsheet, the swing in net trading income.
This is the number. This is the single biggest reason for that 23% headline figure. We're looking at a massive, and I mean massive, LKR 5.8 billion positive swing.
Okay, let's break that down for everyone. In the same period last year, NTB reported a net trading income loss of almost LKR 3 billion.
LKR 2.97 billion in the red.
At this period, they're reporting a gain of LKR 2.84 billion.
So going from nearly 3 billion down to nearly 3 billion up, that's a LKR 5.8 billion difference straight to the bottom line. But you have to understand what this is.
This isn't from making more loans. This is typically from things like the market value of their investment portfolio, government bonds, or foreign exchange trading.
Let's use an analogy. Your net interest income, the 8% growth, that's your regular predictable salary.
Right, money you count on every month.
That LKR 5.8 billion trading swing, that's like winning a one-time lottery ticket because the bond market moved exactly in your favor this year. It's fantastic to have, but you cannot plan your future finances around winning the lottery every year.
And it's deeply connected to the same thing that was hurting their NII, right? The falling interest rates.
Exactly. As interest rates fall, the market value of existing higher yield bonds goes up. So that trading gain is basically an accounting entry. It's the mark-to-market appreciation of the securities portfolio, a windfall from the rate cycle.
So it's not just the lottery ticket. It's a very specific kind of lottery ticket that you can only cash in during a falling rate environment.
Precisely. And that's not the only non-core item propping things up. We also have to look at the LKR 1.69 billion they booked in derecognition gains.
Derecognition gains, which that usually means selling off a specific asset, right? Maybe a non-strategic investment or a parcel of securities.
Yep. They exited something and booked an immediate profit. Another item that you can't really count on seeing again next year.
So if we do the kind of normalization exercise that any serious analyst would do, we take that LKR 5.8 billion trading swing and the LKR 1.69 billion derecognition gain.
You're looking at almost LKR 7.5 billion in, let's call it, low quality or non-recurring income streams.
And suddenly that LKR 14.91 billion profit figure looks very different. If you just assume their trading results were flat instead of that huge reversal, the whole growth story just evaporates.
It collapses. The true engine of growth isn't that 23% number. It's what's left after you strip out all this market noise.
Okay, but it's not all bad news under the hood. We're being critical of the quality, but there are parts of the operation that are showing real sustainable strength.
Oh, absolutely. And we have to give credit where it's due. NTB is showing exceptional strength in two key areas: fee income and pure operational efficiency.
Let's talk about fee income first. This is a much higher quality source of revenue.
It is. It's less sensitive to interest rates, it's recurring, and it comes from actual customer activity. And here they reported a very healthy 9% year-over-year growth, hitting LKR 6.43 billion.
That 9% growth, that feels more aligned with the 8% NII growth. It suggests their core customer base is very active. The sources point specifically to strength in cards and trade.
The trade dominance is really key here. Trade finance is a fantastic business. You're generating predictable fees from letters of credit, guarantees, FX services, all high-value stuff.
And we'll see later that their trade finance loan book grew by an insane 58%. So they're not just lending, they're embedding themselves in their clients' core operations and generating fees from it.
So that's one strong cylinder in the engine. But the real controllable success story, the thing management has direct power over, is their cost discipline.
This, for me, is maybe the most impressive metric in the whole report.
I agree. While they're out there growing their assets by 45%, their operating expenses only went up by 9%.
Let's just hang on that for a second. That divergence is the absolute definition of positive operational leverage.
It's incredible. In this inflationary environment, to hold your cost growth to single digits while you're scaling the business that aggressively, that is just elite level management.
They're squeezing so much productivity out of their existing setup.
And you see it in their cost-to-income ratio, the CI ratio, the key efficiency metric. Theirs improved to 30.68%.
Down from what? Over 33%.
Down from 33.72%.
Yeah.
And a CI ratio of 30% is world-class. It tells you they are running an incredibly lean, efficient operation.
And that, unlike a trading game, is a structural advantage. That's something that will benefit them year in, year out, regardless of what interest rates do.
So to sum up the operational health, the core lending margins are soft, no doubt. But fee income is solid, and their cost efficiency is absolutely superb. The problem is that the headline 23% profit growth is leaning very, very heavily on that non-core trading swing.
Which raises questions about how repeatable that performance is. And look, if you're finding this kind of deep dive, separating the core from the non-core valuable, please take a second to like the video and subscribe to the channel. It really helps us keep doing this kind of analysis.
Absolutely. So that takes us to section 3. This is the ultimate test. It's where the rubber meets the road. Cash is king. We have to compare the accounting profit to the cash flow reality.
This is the true P&L test. Did that LKR 14.91 billion in reported profit actually turn into cold, hard cash in their bank account? Or is it just an accounting number built on optimistic assumptions?
It's so critical in banking. A bank can book income when it's earned, not necessarily when it's paid. So if you lend to risky clients, your profit can look great on paper, but your cash flow will be terrible. That's the divergence we look for.
So let's run the numbers. Reported net profit, LKR 14.91 billion.
Now for the number we really care about. Adjusted operating cash flow, the actual cash the business generates. And that number comes in at LKR 16.44 billion.
Wow. Okay, so the cash flow is higher than the reported profit.
Higher. That is a huge data point. It basically resolves all the concerns we just raised about the quality of the earnings. The bank passes the cash conversion test with flying colors.
Their cash conversion ratio is over 1. It's 1.00x.
And whenever you see cash flow exceeding net income, it's a powerful sign of extremely high-quality earnings. It means every single rupee of that profit is backed by cash, and then some.
A ratio over 1.0 can sometimes mean they were maybe a bit too conservative with their accounting in the past, or it can mean they are just incredibly efficient at collecting their money.
And in NTB's case, it speaks to incredibly efficient collection. It completely de-risks that one-off trading gain. Okay, the gain might not repeat, but the profits it generated were real, and they were collected. It confirms the bank's underlying financial health.
And we can tie this right back to our biggest concern from Section 1. That aggressive 45% loan growth.
Exactly. If they were just throwing money at bad credits to hit a volume target, you would see it here. You would see a buildup of non-performing loans, and cash flow would be lagging way behind profit.
But the data shows the complete opposite. Their credit health actually improved.
It did. The bank actually reversed LKR 355 million in impairments. Last year, they had a charge.
So an impairment reversal means they previously set aside money for loans they thought would go bad?
And now they're saying, actually, these are fine. The borrower situation improved, or we were too pessimistic. So they get to add that money back to the profit line.
It's not a huge number in the grand scheme of things, but the signal it sends about the quality of their underwriting is immense.
And the hard data backs it up. The key risk metric is the Stage 3 ratio. That's your seriously impaired, non-performing loans. NTB's is at an exceptionally low 1.03%.
1%. To maintain that level of asset quality while growing your book by 45% is frankly, a management masterclass.
It tells you their credit process is incredibly rigorous. They are not chasing junk just for volume, and their coverage ratio, the buffer against those bad loans, is a very solid 62.84%.
So Section 3 gives us a lot of confidence. The earnings drivers might have been a bit volatile, but the earnings themselves are real. They are backed by cash, and they are built on a rock-solid, low-risk loan portfolio.
It completely validates the credit decisions they made during that aggressive growth phase.
All right, so with the P&L understood, we have to move to the balance sheet. This is Section 4, where we look for the hidden risks and the hidden strengths.
And we have to start with the biggest risk, which is the tension created by that very same growth push.
So let's revisit the scale. Gross loans up 45% to LKR 417.9 billion.
Driven heavily by term loans and that explosive 58% growth in trade finance.
But you can't just create LKR 127 billion in new loans out of thin air. You have to fund it. And that's where the tension really starts to show.
This is the key risk on their balance sheet right now. While loans grew 45%, deposits only grew by 21%.
So a huge gap. That is an unequal race between deploying assets and raising the money to pay for them.
And the single best metric to capture this is the loan-to-deposit ratio, or LDR.
And NTB's LDR has tightened aggressively. It shot up to about 90%.
Up from around 74% at the start of the year. That is a 16-point jump in 9 months. That's a huge move.
So what that 90% means is for every 100 rupees they have in customer deposits, they've already lent out 90 of them.
It means they are incredibly efficient. Yes, they're not letting cash sit idle. But it also means they are running with a much thinner margin of safety.
And the source material is very clear on this. An LDR crossing 95% is widely seen as a warning sign for funding stress.
And they are at 90%. They are 5 points away from that zone. If they keep up this pace of lending without finding a lot more deposits, they're going to hit that wall very, very soon.
It sounds like a real tightrope walk.
It is. I mean, on one hand, their internal efficiency is amazing. They funded LKR 127 billion in new loans with LKR 119 billion in new deposits. They are masters at turning deposits into loans. But that same efficiency has used up all their slack.
So what's the immediate risk? If demand for loans stays high, what happens?
They have two bad choices. Either they slam the brakes on lending, giving up all that market share they just fought for, or they have to go out and raise expensive short-term funding from other banks.
And either of those choices would hurt their future net interest income.
Exactly. So that liquidity tension is the big immediate risk. But now let's pivot to the other side of the balance sheet, the hidden strength that actually allows them to even attempt this strategy.
And that's their capital position.
They are massively overcapitalized, and this is a huge strategic advantage.
It's a hidden strength because excess capital doesn't earn a high return on its own, but it gives you incredible security and, more importantly, options.
And their ratios are just miles above the regulatory minimums. Their Tier 1 Capital Adequacy Ratio, or CIR, is 18.90%.
The minimum is 8.50%, so they have more than double the required core capital.
And their total CIR is 20.03%, way above the 12.50% minimum.
So what this tells us is that NTB isn't constrained by capital. They have all the capital they need to grow. Their only constraint is funding, which is why that LDR is so tight.
Right. And you see the strength in their net asset value per share, too. It jumped over 17% to LKR 282.35. The intrinsic value of the bank is growing nicely.
So how does this capital strength translate into strategic options?
Well, it gives them immense financial agility. The analysis specifically notes that NTB has massive headroom to fund the LKR 18 billion acquisition of HSBC's Sri Lankan operations internally.
That is a critical point for shareholders. An LKR 18 billion deal is significant. The fact they can pay for it out of their own pocket without issuing new shares and diluting existing owners is a huge testament to their capital strength.
It really is. And this is where all the pieces of our analysis come together.
You're connecting the acquisition back to the problems we identified earlier.
Exactly. We found two main structural pressures. Right. One, their NIM is getting squeezed because their funding costs are relatively high.
And two, their liquidity is getting tight, shown by that 90% LDR.
The HSBC acquisition is the strategic masterstroke designed to solve both of those problems in one go.
Because they're not just buying loans, they're buying HSBC's deposit base.
They are buying a liability structure. The whole point of the deal is to significantly improve their KSO ratio.
KSA, meaning current accounts and savings accounts.
Which is the cheapest source of funding a bank can get. Current accounts pay 0 interest, Savings accounts pay very little.
So by injecting a big chunk of these low-cost HSBC deposits onto their balance sheet, they can fundamentally lower their overall cost of funds.
Which is the most direct way to fix that 6.15% IM problem. It gives them an immediate and structural boost to their future margins.
And at the same time, a bigger, cheaper, and more stable deposit base is the perfect solution to the tight LDR. It gives them the breathing room they desperately need.
So they're using their greatest strength, their massive capital, to buy the solution to their two biggest weaknesses: funding cost and liquidity. Brilliant balance sheet engineering.
And if that insight, connecting capital structure to M&A strategy, is helping you see the bigger picture, please do hit that subscribe button. We try to connect these dots in every single deep dive.
All right, so let's bring it all home. Section 5, conclusion and key takeaways. We started this whole thing skeptical of that 23% profit number.
And after digging through everything, I think we can boil down the true P&L into 3 main lessons for investors.
Lesson number 1, core trends were masked. That LKR 5.8 billion trading swing was a huge one-off that hid the fact that core NII growth was pretty soft at 8%. The bank's future profitability really depends on them fixing that NI.
Lesson number 2, liquidity tension is the key risk. That aggressive 45% loan growth pushed their LDR to 90%, which is getting uncomfortably close to the stress zone. That's the metric you have to watch like a hawk in the next quarter.
And lesson number 3, capital is their strategic weapon. Their massive 18.9% Tier 1 ratio is the superpower that lets them go out and buy the solution to their problems, the HSBC deal, without hurting shareholders.
So when you put it all together, what's the final verdict?
The final verdict is, I think, nuanced, but it's very positive if you're a long-term investor. NTB is being incredibly aggressive in capturing market share.
The 45% growth.
But they're doing it while maintaining incredible asset quality.
The 1.03% Stage 3 ratio.
And best-in-class operational efficiency.
The 30.68% CI ratio. So they're strategically bold, but also incredibly disciplined in their execution.
But that liquidity tension from the 90% LDR is the big immediate risk they have to navigate.
And the HSBC deal is the answer to that risk, but it will take time to integrate.
Which brings us to our final provocative thought for you to take away.
We know NTB is using its capital to buy the solution to its funding problem. But what happens if the timing doesn't work out perfectly? What if that LDR crosses the 95% stress threshold before the HSBC acquisition is fully bedded down and those cheap SaaS deposits start flowing in?
That's the race against time. If their loan growth stays hot and they breach that 95% level, does it force them into the wholesale market to raise expensive short-term money just to bridge the gap?
And if they have to do that, the cost of that funding would hit their NII immediately.
It would completely negate the very margin improvement they're trying to achieve with the acquisition. It could create a painful temporary profit squeeze. So that tension, the race between their LDR growth and their Keysight integration, that is the #1 thing you need to monitor going forward.
And that is the real story behind the numbers. Thanks for joining us for this deep dive on Nations Trust Bank. As always, this is not financial advice. It's an educational analysis of the source material. Please continue to do your own research.
Always look past the headline, always check the cash conversion, and always understand the balance sheet. Until next time.